Hello everyone, welcome to Demand Supply Trading Practical session number 44. Myself, Srijit Kakar, and today is Sunday, 17th of November 2024. And before we move ahead, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, before we move ahead, I would like to add that we have a group on Telegram now, not a group, a channel on Telegram, where we keep updating you regarding our upcoming sessions. If we have any promotions coming up, or if there are any tips and tricks regarding demand supply methodology, so we keep posting and updating, uh, different content on that particular channel. So, in case you've still not joined this channel, you wish to join it, you can scan the QR code which is available on the screen. Otherwise, the direct link is available in the description. You can also search for demand supply trading on Telegram and you will be able to find the channel as well. Now, talking about today's session, it is practical application of demand supply methodology. Our demand supply course is available as a 100% free course now. If you've still not gone through the course content, the link to the course content is available in the description. By going through the course, you will be learning the methodology theoretically, but it will be the complete methodology, right? Nothing is missing. So you'll be learning what are demand areas, what are supply areas, how to identify them, how to qualify them, how to do multiple time frame analysis. So everything is covered theoretically. But unless and until we look into some practical examples, we at times don't get very good understanding of how to implement it. And that is what we do in these sessions. So every weekend, I do a practical session where we take some examples, and to those examples we apply the complete methodology so that we can understand how to plan trades very mechanically and rule based. Now, the beauty of these sessions is that when we are looking into these examples, I'm not picking something which has already happened and giving you reasons. Okay, this is why we could have bought, this is why we could have sold, because that is something which anyone can do, right? All you need to do is just pick up any move which has already happened on the chart, pick any indicator, pick any oscillator, and you can come with a number of reasons why you could have participated in that move. But the real challenge is when you are planning your trades well in advance. And that is the beauty of demand supply methodology, that we can pre-plan our trades, and that is why demand supply is also called as a set and forget methodology. So we are doing our analysis in advance in these sessions, and just because we are doing the analysis in advance does not mean that I do this analysis and then we forget about it. Whatever analysis we do, whatever trades we look into, whenever they get triggered in the future, I also review them for you. And the reason I'm reviewing them for you is so that you can see both the before as well as the after. And when you see the before and after, yes, you start building up confidence in the methodology. And as you build more and more confidence, you will get inclined towards learning it, implementing it, and that is how eventually you start getting into demand supply trading. So yes, before we start with today's example, we have one example which was getting carried forward from the previous session. Though I did talk about that the reward to risk ratio is not really good, we could close the trade. I mean, we should close the trade, not good. We should have closed the trade, but I still said we'll still look into it unless and until we get an exit on it. So that is why I'm still continuing with it as a review. And on top of that, we also had the three examples which got triggered in this week. We'll also look into them as well. All right, so just give me a second. Let me bring up the very first one, and then we'll start with the examples which also got triggered this week. So I'm starting with the one which was getting carried forward. Just give me a second, please. All right. So the one which was getting carried forward is session number 38. So we did the session on the 6th of October, and the prices came into the zone on the 22nd of October. And the last time also we talked about that the reward to risk ratio is not really good, but you can see the zone is still holding. It has not yet hit our stop loss. I did talk about that, when the market opens this week, if you want to exit immediately, you can do that. Or if you want the prices to move a little above, maybe, you want to exit as a break even trade or your stop loss. Yes, you can try for it. But otherwise, you can see the zone is still holding. It has not yet been breached. So unless and until it hits the stop loss or give us a break-even exit, we'll still keep tracking it and see how this one works out. So that takes care of the one which was getting carried forward. Now let's look into three examples which got triggered this week. So I'm starting with the first one. Now this is from session number 41. The session was on 27th of October. It was a type 2, type 3 trade for us, and the prices came into the zone on the 14th of November. Now, the very first thing is, as a type 2, type 3 trader, even before entering the trade, the first thing we have to ensure is that we have good reward to risk ratio. Now, here, what you can see is when the prices came back into the zone, my opposing zone, fresh, right? If I have to look at fresh zone, I'll have to bring up all structures of demand and supply, is somewhere around here. You can see we have a structure of a rally based drop, and you can see this is giving me a reward to risk ratio that is maybe 1.5. So the very first challenge is reward to risk ratio is not good, and if your RR is not good anyhow, we should not be participating. The other thing you can also see is that while we were planning this trade, we were very low on the curve, which implies I can also check my target on the intermediate time frame, and that is where your reward to risk ratio again is really bad. You can see, this week when the candle closed, we have our target which is less than 1:1. So irrespective whether it is the lower time frame or the intermediate time frame, the reward to risk ratio has been spoiled, due to which we should have avoided the setup. But yes, just as an example, how do we take type 2 type 3 trades? In type 2 type 3, we wait for the prices to come inside the zone. Now if you're not very conservative, even a bullish candle will do. So you can see this candle is technically a bullish candle, so this could have been your signal, provided you had reward to risk ratio, that if you want to do it as a type 2 trade, you can immediately buy at the market price. If you want to do it as a type 3 trade, now you can buy when the prices are leaving the zone. But like I already said, in this trade setup, the reward to risk ratio was not really nice, due to which this should have been avoided. So that takes care of example number 41. We have two more. The next one is example number 42, right, from session number 42. So just give me a second. Let me bring that up. So now this one is from session number 42, which was on the 2nd of November. And you can see we came into the zone on the 13th of November. Now, the problem is when the prices were coming into the zone, this zone would have been a fresh zone. You can see when the prices were coming into the zone, this would have been a fresh zone. And at that given point of time, if I was looking at my reward to risk ratio, it would have not been a challenge, because at that point of time, a fresh zone would be somewhere away. And the problem, the other challenge here is, because this is a daily candle, only after the closing of the candle this will form as a zone, right? So at the time of arrival, this zone would not be there. So since this zone would not be there, I would be looking for my target somewhere in the past. So reward to risk ratio was not a challenge at the time of entry, but after the day closed, now we can see we have an opposing zone which is right here, and that is killing our reward to risk ratio. Now for this, again, we'll check where are we located on the curve, and you can see we are very low on the curve, which again means I can double check my target from the intermediate time frame. And on the intermediate time frame, you will see we again have the same challenge, which is our reward to risk ratio has been spoiled, not even a 1:1. So since after the entry, the reward to risk ratio has been spoiled, this is where the zone would have formed. Now the only alternative you have is to exit when prices hits this target, which you definitely got the opportunity. So this could have only given you maybe a point 2, point 0.3, nothing more than that. But the zone is still holding. You never know, maybe starting tomorrow prices might start moving up. But as a rule based trader, like I always say, that whenever we are getting into trades, we need to ensure we have good reward to risk ratios, because we understand every trade is not going to be a profitable trade. We only want to get into trades where RRs are good, so that even if we have quite a few stopped out trades, the reward to risk ratio keeps us on the positive side. And the last example which got triggered this week is this one. So this is from your session number 43, which was on the 9th of November. This was again a type 1 trade for us. And now in this example, you can see when the prices came back into the zone, the opposing zone is really far away, which is showing us more than 2:1. But what happened here is, after entering the zone, we got a move which was about 1:1, a little over 1:1. And at 1:1, we can make our trades as break-even trades. So after making it as a break-even trade, we again came into the zone, and you would be out of the trade as a break-even trade. So the reason I'm showing you these examples, like I already said, is because we are always planning in advance, and you can see when the prices they come to our zones, how beautifully they react. Yes, at times those moves might not be very big moves. At times these moves might give us maybe small profits or break even opportunities. Plus the next challenge is that I'm only reviewing it the week it came into the zone, right? These are monthly income trades where, it can take a few months or maybe even few months before we get those big moves, which we might not be able to see as of today. And again, because we are planning trades as very conservative trades, as a very conservative trader, the rule book that I've given you, but eventually you might want to hold on to these trades because these are very conservative trades. And after maybe 2 to 3 months, if you might look at it, the prices might be doing something like this. I have shown you similar cases in the past as well. But yes, while we are planning trades, let's follow a very conservative approach. And another thing which I would like to add here is you can see for the past few weeks, the markets have been very bearish. And almost every other session, I have been showing you that even in these bearish markets, the zones have been giving us bounces. The zones have been giving us opportunities to make them as break-even trades. They have been giving us opportunities maybe to trail onto it or maybe have some partial profit booking, small little profits. And the challenge with me, I have talked about this many, many times, is that the challenge is that I only plan long trades. Why? Because I only trade the NSE cash market, and in cash market you can only take long trades. You cannot take short trades and keep them as overnight trades. So that is my limitation. But if you are somebody who is trading markets where you can plan short trades, or maybe you are someone who is also planning short trades in futures, then just think about it, right? In such bearish markets, if the demand areas are working so beautifully, if you would have planned some short trades, they would have given you amazing moves, right? And again, the markets are bearish. Eventually the markets will get bullish. Once the markets they get bullish, you never know, some of these examples that I shared with you, they might be really nice big moves, right? They might be moves which might be 10 is to 1s, 20 is to 1s, 30 is to 1s, right? So you can get those kind of moves as well. But again, since the markets have been bearish, yes, you need to understand that's my limitation, that I only plan long trades. But still you can see how beautifully the zones are holding. Definitely every zone will not work, but eventually, as I've shown you in the past as well, when these trades they start going in our favor, the reward to risk ratios are really, really nice, and that is the key to profitable trading. It's never the hit rate. All right, so now that we have looked into the examples which got triggered this week, let's look into the trade example for today's session. So just give me a second. Let me bring that up. So today's example is a case of level on top of level. I guess it's been a while we haven't taken a case of level on top of level. So today I picked up something which would be a case of level on top of level. And that will also help us revise how do we check whether we have a case of level on top of level or not. And if we have a case of level on top of level, what modifications we do. Now, coming back to trading, whenever we talk about trading, I always say trading has to be a very mechanical and rule based process. Now, why it should be mechanical and rule based? I have explained this in a video, and the title of that video is How to Start Trading. The link is available in the description. So, in case you have not yet watched that video, make sure you watch it, go through that video, follow the process that I've explained in that video, because there is no bypassing it. Eventually, everyone has to go through that process. The sooner you start, the better it is going to be for you. Now, when you have just started learning how to trade, or when you've started learning a new methodology, it's not very easy that from day one you can create a trade plan for yourself, because to create a trade plan, you need to have good enough experience, right? Once you have good enough experience with that particular methodology, yes, then you can convert it into a rule based system. But until you have that experience, it's difficult to convert it into a rule based system. And to overcome this challenge, I have created a ready-made trade plan for you, which is a combination of two documents. The first one is your trade plan steps, which is basically a flow chart, or you can also call it as a walkthrough. This guides you what you need to do as a demand and supply trader step by step. And the other document is your rule book. Like I said some time back, this rule book is a conservative approach, because whenever you're learning something new, definitely makes sense to start a little conservative. As you start having more and more experience, you want to make modifications to it, you want to make it more aggressive, you want to make it extra conservative. Those modifications can be done as per your preferences. So what is our step number one whenever we start planning our trade? So step one is I need to define my trade purpose. Now the question is, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade, which is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit here, the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss. any kind of exit. So now the question is, why are we starting with the trade purpose as our step number one? And the reason we are doing this is because when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are a number of time frames. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We again follow a very logical approach. And that logical approach is that the longer I want to be in the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into four different purposes, and we call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important thing which I always add here is that even though by definition I say daily income is a trade which can last for a day or few days, but when you're trading markets which are not 24-hour markets, like if you take the example of the Indian NSE market, it is not a 24-hour market. And I'm pretty sure if you people have been trading this market, you would have experienced that whenever the market opens, some symbols they gap up, some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight in a market which is not a 24 hours market, we do have that gap risk, inherently uh, ingrained into it, right? There is no way to avoid it. And that is why initially, as a risk management rule, my recommendation to all of you would be that initially your hourlies dailies should be done strictly as intraday trades. We don't want to have that unnecessary overnight gap risk by keeping those positions overnight. For weekly monthlies, we have no choice because here we are anticipating that these positions can take few weeks or maybe few months before we get our exits. So here you have no choice but to keep them as overnight trades. But that does not mean that for weekly monthlies you cannot have gap against you. It can still happen, but because you're leaning against some bigger time frames, the probability definitely reduces. Because like I always say, the bigger the time frame, the higher the weightage. Plus, when you're doing your weeklies, monthlies, the zones are also a little wider. So even if you get a gap against you, it might not be a very huge gap, which might make the price gap beyond your zone. Maybe the prices might gap a little deeper into the zone and still react from that zone. Or even if they don't react, and because they are still inside of the zone, by the time the zone is violated, you still lose whatever your predefined risk was versus gapping beyond your zone. So you can still have gaps, but the probability reduces a little bit because you're leaning against some bigger time frames. But with time, with experience, if you want to include daily incomes into overnight trades, that can be done. There is nothing wrong with that. It's just that initially, as a risk management rule, we are avoiding it. So step one is I need to define my trade purpose. Let's assume I opted, I want to plan monthly income trades. Now, once I have defined my trade purpose, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if we go to page number 28 in the rule book, we start with our topic, which is multiple time frame analysis. Because demand supply methodology is not based on single time frame, demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames that we utilize? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supply for our entries and exits, and the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames, and we get the answer from this table. Like in this example, I opted I want to plan monthly income trades. So here you can see as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly is the higher time frame used for curve analysis. Weekly is the intermediate used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss entry target and size. And in case I need to use my refining time frame, it is going to be the 60 minutes chart, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules, I can use this time frame. Now, mind it, this table, which is on page number 31, is specifically for the NSE market because this market is open for a very short duration, which is around 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, then you can refer to page number 32. This can be used for forex, commodities, markets which are open for longer duration, cryptocurrencies, right? So based on how long your markets are open, you can make your decision whether you want to go for this table or you want to go for this table. Now, as soon as I'm done with my step number one, now I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number one is taken care. Now the next challenge is, yes, I do know my time frames, but if I again take the example of the NSE exchange, so on the NSE exchange we have over 2000 plus companies listed. So humanly not possible for us that every day we sit and analyze 2000 companies. So our next step is to select few scripts out of this big list, because if we have a smaller list, we can do our analysis almost every other day. But if I have to go through 2000 plus companies every day, not an easy task. So how do we do this? For this, we use certain computer programs which are called as scanners or screeners. And the way these computer programs, they basically work is that we input certain conditions into them. These are the conditions I'm looking for. And then that computer program identifies that out of these n number of symbols, which symbols are matching with those conditions. And whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a smaller list. Now, a few examples of these scanner screeners. Example number one, if you uh, go to my website, you will see under the free tab, I have created a scanner for you. And that scanner is based on some moving averages, and that can help you in shortlisting symbols. Second example, on my YouTube channel, search for scanner. You'll be able to find few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on that, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll again be able to find a video on top-down analysis, which can again help you in shortlisting symbols. So these are 3-4 different examples of scanner screeners, but you're not restricted only to these 3-4. We'll look at few examples before we move ahead. So like I said, once you come to our website, under the free tab, you have the option which is stock screener. Because I want to plan MIT trades, I can run the long scan and the short scan. And here you can see the long scan is shortlisting 3 symbols for me. The short scan is shortlisting only 1 symbol for me. Now, very, very important thing which you always have to remember. Just because I'm getting these 3 symbols in the long scan does not mean I'll blindly buy these 3. Similarly, just because I'm getting this 1 symbol in the short scan does not mean I'll blindly sell this one. So always remember, the scanner screeners, they never tell you what you need to buy or what you need to sell. The job of the scanner screener is, I can't analyze 2000 plus companies every day. It gave me a list of 4 symbols which I have to now manually analyze. Out of these 4, if anything matches with my trade plan, I have an opportunity. If nothing matches with my trade plan, I don't have any opportunity. So remember, scanner screeners are not giving you ready-made trades. They are just helping you get a smaller list which you will have to analyze manually. Now, many times what can happen is your list can be a very small list, like you can see today, or maybe it is not even generating a single result. Now, the problem here is, if you are not getting any results or your list is a very small list, the probability of finding something which is an exact replica of your trade plan reduces. So if you want that whenever I'm using these scanners, my list should always be a little bit bigger, then what you can do is, you can see that in this scanner, I have given 5 different conditions. You will disable the third one, you'll run the scan again, and I'll do exactly the same thing here. I'll disable the third one, run the scan again. And now you can see that initially it was only shortlisting 3 symbols for me, but now instead of 3, it is giving me 65. And here it was only shortlisting 1 symbol for me, but now it is giving me 9. So we have 65 plus 9, which is 74 symbols to look into. So you can see this is how you can make your list a little bigger. You can make your list a little smaller. Plus, these are not the only scanners available to you. If you go to the screener section on this website, you can see you have over 150,000 scanners available on this particular website. Some of them are based on fundamental analysis. Some of them are based on your top love. Then you have your candlestick patterns, then you have your range breakouts, you have your bullish scan, you have your bearish scan, you have your intraday bearish, intraday bullish, you have your crossovers. So you have n number of scanner screeners available to you, and this is example of one website. If you'll do a Google search, you'll be able to find n number of websites, n number of scanner screeners. Whatever you feel is the best fit for you, that is what you can use. So in this example, you saw we got a list of about 74 symbols. Now once you start analyzing these symbols, there are a few more challenges which you'll face. So let's also touch upon what those challenges are. So challenge number one is, what you'll realize is that once you're going through this list, majority of the symbols in this list, they do not have a quality demand zone or a quality supply zone. And the reason for that is, all these 150,000 plus scanners we talked about, they are either built on conventional technical analysis or fundamental analysis. So that is why, just because something is getting shortlisted does not guarantee that you'll have a quality zone on the lower time frame. And if you don't have a quality zone available, you can't plan your trade, because for planning our trades, we do require quality areas. Second, if there are some quality areas, so in a way, what you're doing is you're wasting a lot of time analyzing such symbols where nothing quality is available. Now, some of the symbols which might have some quality zones, those quality zones might be far away from the current market price, due to which you'll have a longer waiting period before the prices are back. And during that waiting period, again, what can happen is, the price action which develops, it might disqualify the trade setup by the time it is back into your zone. So these are some of the challenges we face when we are using scanner screeners which are based on conventional technical analysis or fundamental analysis. And to overcome these challenges, I have also created two custom built tools. One is called as the alert service, the other one is the screener. Before we understand what alerts and screener is, let me also add, these are not call giving or tip giving services. These are scanner screeners. Only difference is that both these scanner screeners are purely based on demand supply zones. Now, if you want to have a better understanding how they work, the links are available in the description, the walkthrough videos. You can go through them to understand them better. But let's just briefly understand them, touch upon them, so that you have a vague idea how they basically work. So talking about alerts, what alerts they basically do is that as soon as you have a formation of a demand area or a supply area during the live market, it immediately notifies you. Now, there are two ways to get notified. One is, when you're subscribing, you get the option for NSE, MCX, and Forex. And if those are the markets you are trading, you can choose out of those three markets for which market you want your alerts through our Telegram channel. So we have a predefined list of some symbols. We provide you alerts for those symbols via our Telegram channel. But we understand that we have a vast array of markets available, the world over, and it's not possible for us to cover every market through our Telegram channel. So that is why you also get access to a custom built indicator on TradingView, which is called as demand supply zone alerts. And with that indicator, you can create your custom alerts on any markets which is available on TradingView, on any time frame which is available on TradingView, taking into consideration your TradingView subscription level, right? So if you have a free account, you can only create one alert. If you have a paid account, you'll be able to create multiple alerts. Free account, you cannot have custom time frames. Paid account, you can have custom time frames. So all those limitations would apply. But yes, those are the two ways you get these alerts. And for alerts, we also have demo channel. So I'm just showing you some examples from the demo channel so that you can see how alerts they basically work. So here you can see the alert from the last trading session, which was on the 14th of November. And you can see, as and when during the live markets the zones are getting formed, you get the notification, at what time the notification was generated, what is the name of the symbol, what was the structure of the zone, on what time frame the zone has formed, what is the proximal value, what is the distal value. So again, I'll add, these are not ready-made calls or tips that you have a formation of a demand area or a supply area, so you can buy at that demand or you can sell at that supply. That is not what this is. This is telling you, okay, on this particular symbol, on this time frame, a demand zone has formed or a supply zone has formed. Now it is your job to verify whether that demand zone or supply zone matches with your trade plan or not. If it matches with your trade plan, it can be an opportunity for you. If it doesn't match with your trade plan, it has no meaning. So this is what alerts they do. They keep updating you as and when you have a formation of a demand or a supply area during the live market. The second tool we have is called as the screener. Now, the way screener basically works is, again, you can input your own list of symbols in this, and then you provide your proximity percentage. Like I've given my proximity percentage is 1%. So what I'm doing is I'm basically telling the screener, okay, these are the 40 symbols, but out of these 40 symbols, only tell me the symbols where my current candle will be within 1% to a demand area or a supply area. Now, if I take my example, someone who only plans long trade, then I know there is only one symbol, which is infi. If I go to infi, where the current candle is close to a demand area. So in a way, I don't have to analyze the rest of the 39 symbols. So can you see how much time did I save? Plus, I'm also identifying the one where I'm pretty close to the zone, which increases my probability of the fill. And plus, if I just change the time frame, now I'll have the result based on whatever time frame I am on. So if I go to weekly, you will see that on the weekly it's telling me that we don't have even a single symbol which is close to a weekly demand area. That is 1% proximity, but to supplies we have quite a few. So this is how your screener basically works. It has nothing to do with the zones which are getting formed just today, whether the zone was formed today or yesterday or a week ago or a month ago or a year ago or 10 years ago. As long as we will be in that in that proximity percentage range, it will shortlist for you. So again, second step is to get a smaller list. How you get that list, it's completely your choice. I showed you a number of ways to do it. Process can be as simple as, because I want a smaller list, I'll only be analyzing my Nifty 50 symbols, or maybe I have my own favorite list of symbols which I want to analyze every day. So choice is yours how you want to get that list. But once you have that list, you have everything required to move on to the next step, because from our step number 1 we got to know our time frames, and from our step number 2 we got to know what symbols we'll be analyzing. So let's assume the very first one was ABC. So what am I supposed to do now? I need to go to the lower time frame on ABC, and I need to identify a zone. Now, what do we mean by zone? By zone, we mean any of these 4 structures. Now, the best part is, even when it comes to the analysis, identifying zones, multiple time frame analysis, I have created an indicator which is called as demand supply zone indicator. You can see it is already applied to this chart. So I don't have to identify the zones. The indicator does it automatically for me. It plots the zone for me. I also get to know which zones are fresh, which zones are tested based on the color coding. And everyone can now have at least a 7-day trial access to it. So let's talk about that as well. So we are providing a free 7-day trial for the demand supply zone indicator. It is a one-time trial. So in case you have still not tried it out, you can go into the description. You'll find the link to a Google form. Just fill that form with your correct TradingView username, because if you're providing an incorrect TradingView username, it will get activated for somebody else, right? To have it activated for you, you need to provide your correct TradingView username. Once we get that information, within 24 hours it will get activated for you, and once it is activated, you will get your notification on TradingView itself that the indicator has been activated, and then you can enjoy it for 7 days. Even after that, if you want to use, we also have the demo version available, which you can use forever. The only limitation of the demo version is that it can only be applied to the daily time frame. It will not work on any other time frame. But yes, if you want to try for a longer period, then you can even try out the demo version. All right, so coming back to the chart, because I need to identify zones, you can see that below the current candle, we have a demand zone, which is right here. Like already said, now I don't have to do it. The indicator is automatically doing for me. So we have identified a zone, which is a rally-based rally. So my step number 3, which was to identify zone, is already done by the indicator. Do we have a zone available? The answer is yes, we do have a zone available. Now, once you have identified the zone, does not mean you'll blindly trade it. The next step is to qualify that zone before we decide whether we want to use it or not. And for qualification, it's a 2-step process. Step 1 will qualify based on certain conditions. Step 2 will qualify based on the booster scoring. So the first thing we'll check is that, can the zone be a case of level on top of level? And the reason we start with level on top of level is because if it proves to be a case of level on top of level, I might have to shift from the zone I've already identified to a different zone. And how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So when your intermediate time frame zone is dividing into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if we have a coinciding level, the possibility is that it might be a case of level on top of level. But if we don't have a coinciding level, it cannot be a case of level on top of level. So let's verify the zone we have identified, which is this one. Does it coincide with any intermediate time frame? Now, the beauty of this indicator is you can also define your higher time frame, your intermediate time frame, your refining time frame, and then you can check mark automatic settings, so that whenever I switch to these time frames, these settings, they get applied automatically. So if I go to my weekly now, you will see that on the weekly, it will identify the zone for me. And here you can see we do have a drop based rally structure. So let's draw this drop based rally. But this time I'll use a different color so that we can differentiate between the two. So the one in pink is my intermediate time frame zone, the one in green is my lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes, and that is what we call as a coinciding level. So here you can see the concept that I was talking about, that once you have your intermediate time frame zone and the same intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level, and that is exactly what we see here. So what we should be doing in such a case, instead of using this upper level, I should be going for the lowest level. That is what we should be doing, and that is the modification we'll make here. So we'll skip this one and we'll move on to the lower zone, which is right here. Now, if you just want to use the lower zone the way I've just marked it, it is absolutely fine. It is acceptable. It can be done something like this. But I have talked about this many, many times in the past as well, that I am a conservative trader. And because I'm a conservative trader, I also understand that if the prices, they go a little deep into this weekly zone, I might get stopped out and then it might start reacting from this weekly zone. So whenever I see such scenarios, I always prefer that my distal line is coming from the intermediate time frame zone to be a little on the safer side. So I'll be pushing my distal line to this one. And by doing something like this, you can see that now my stop loss is below the distal line of the intermediate time frame zone, not just the lower time frame zone, so that even if the prices, they go a little deeper into the zone, I'm still safe unless and until the zone is violated. Right now, is it mandatory to make that modification? The answer is no. It completely depends upon your trading style, because a narrower zone has its own advantages. A narrower zone, even a small bounce can give you good reward to risk ratios or opportunity to make it as a break even trade. For wider zones, you definitely need your opposing zones to be really far off for good reward to risk ratios, and even a small bounce might not give you small profits or maybe an opportunity to make it as a break even trade. So at the end of the day, it's your call how you want to go about it. Like I already said, I am a little on the conservative side, so I always prefer to go with this approach. Right, so my condition number one, which we wanted to verify, was that is this a case of level on top of level? The answer is yes. Whatever modification was required, we have made that modification. This zone is not because of a gap. Gap rules will not apply. Pivot non-authenticity is again not applicable because it's a rally-based rally structure, and unstable equilibrium is also not applicable. So after looking at all the applicable rules, is the zone qualified? The answer is yes, because none of these conditions disqualified the area for us. So this area is definitely qualified for us. Now, once we have qualified the zone, does not mean we'll blindly trade it now. The next step will be its booster scoring, for which we'll bring up the booster sheet. So the first one is freshness. Now, what you can see here is that the lower zone has already been tested. That's why you can also see the zone is marked in cyan color instead of green. Green means fresh, cyan means it is a tested area, but it is a shallow touch. So for shallow touch, I'll give it a score of 1.5. Again, if you talk about the strength, you can see this is not an explosive move. In fact, if I change my indicator settings that I only want zones with explosive moves, it is not an explosive move, it is a good move, because of which I'll give it a score of 1. Time at the zone, we only have one candle, which is a score of 2. Reward to risk ratio we are taking as an assumption. Now, if I go back to the rule book, you will see that there are certain characteristics of cases of level on top of level. So remember, these characteristics might not apply every time, right? At times, none of them might be applicable. At times, one, at times, two, at times, maybe all three. But always remember these characteristics. The very first characteristic is, in case of demand, the lower zone might be tested by the upper zone. That is what we just saw. Second, in case of demand, the lower zone might be lesser strength versus the upper zone. That is also something we can see. The upper zone has really nice, better strength versus the lower zone. And the third is that in case of demand, the lower zone might also have more number of candle versus the upper zone. So at times what might happen is the upper zone has just one candle. The lower one might have 2, 3, maybe 6, 7 candles. So all these factors which we are talking about, the characteristics we are talking about, are basically characters which does not connect with a quality area, but you will be able to see those characters very frequently. So even though we see those characteristics, what you need to understand here is that level on top of level basically implies that you are trading the intermediate time frame zone by fine tuning it on the lower time frame, because my intermediate got divided into multiple zones, and now I'm trading the same intermediate time frame zone by fine tuning it on the lower time frame. So when if I go back to the intermediate, You can see on the intermediate, if I wanted to trade this zone, by wick to wick method, my entry would be a little higher. Body to wick, it would have still been a little higher, but now I have been able to fine tune my entry, and I'm trying to take a deeper entry into this zone, but basically it's the same area. So what you need to remember is, since you're trading the intermediate time frame zone by fine tuning it on the lower time frame, therefore if you see the above set characteristics, you can ignore them and you can do the rating of the zone based on the intermediate time frame. Now always remember, whenever you're doing this, boosters which already have the highest score, you don't have to play with them. Only the ones which do not have the highest score will see that can we make the score a little better. So the first one is freshness, and now you can see that on the intermediate time frame, the intermediate time frame zone is still fresh, so I can upgrade it to a score of 3. Now talking about the strength, you can see that on the intermediate time frame, if I disable this and if I say now I only want quality zones, with the quality being explosive move, it is also identifying this area for me. So we understand that on the intermediate time frame, in fact, we have an explosive move which will again upgrade the scoring of the zone to a score of 2. So something which was a medium quality zone, a score of 7.5, by looking into this rule that we have in the rule book, we have been able to upgrade it to a score of 10, definitely with the assumption of reward to risk ratio. Next, what is the location? If I go to the monthly, you can see that we are planning this trade at the best location. You can see we are inside of a monthly demand area. So best location gets a score of 2. At best location, trends are irrelevant, irrespective whether it is up, down, or sideways. It is going to be a score of 1. Move from the zone, we already have a move which was more than 4:1. So can you see this is my 4:1? Probably we have a 20:1 move before the prices are coming back. Gets a score of 2 again. It is a case of level on top of level. It is also coinciding. And for trap also, I can give it a score of 1, because you will see that if I take a horizontal line wherever the proximal is and I start pushing it up, you can see somewhere around here. In fact, if I bring in a little more history, you can see this has been acting like support, has been acting like somewhat resistance, right? Again, here it has been acting like support. So in the recent past, not very clean, but in the past, it has been working very beautifully as support resistance. So we do have a nice neat area which is sitting right above our zone, which can make this zone work like a trap for us. So just give me a second. Right, so this can make the zone work like a trap for us, for which we can give it a score of 1. So if you look at the overall scoring, we have a score of 10 out of 10 for quality and 8 out of 8 for probability, making it a high quality, high probability trade setup, which can be done as a type 1 trade. Now, very, very important thing which you always have to remember. Can you see this zone has the highest score a zone can ever get, which is 10 out of 10 and 8 out of 8. So what I have seen is that many times people, when they see that the scoring is the best scoring, they start believing this will be 100% sure shot trade and it is going to go in our favor. Remember, the scoring is never for the surety. The scoring is always for the quality and the probability. So no matter how high the quality, no matter how high the probability, it can still be a stopped out trade. So that is why, just because you see the highest score, do not get into the greed mode and start risking more than what your trade plan allows you to risk. So do ensure you do your proper position size calculation. Whenever the prices are back, you'll have to re-verify, because like always say, markets are not static, markets are dynamic, conditions are changing almost every other second. So before entering into the trade, you'll have to re-verify that does it qualify with my trade plan. If the answer is yes, you place your order based on the entry type, in this case a type 1 trade. And once your order has been executed, the last step is your trade management, where step 1 is 1:1, we make it as a break even trade. And after that, if you get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically, very rule based. And I can see we have some questions in the chat box as well. So before I get into those Q&As, let me add, if these sessions are helping you, then do like the video. And if you are on some trading groups, or if you have any friends or family members who are into trading, you can also share the link to my videos with them, to my courses with them. And even the 7-day free trial that we have now, you can share it with your friends, family members. If you're on some trading group, you can also share there, because it's not that you need to know demand supply methodology. Even if you want to try it out as a tool which you want to use as a confluence, right? So whatever your strategy might be, you'll say, okay, whenever my strategy tells me now I can be a buyer or now I can be a seller, let me see if I have any confluence with the demand supply areas. Based on that, I'll be taking my trades. So you can try it out a number of ways. But even if you don't know demand supply, like I already said, now the complete methodology is available absolutely free. Plus, these practical sessions are also free, so anyone can learn the methodology and you can start implementing it and you can start trying it out. All right. So that being said, let's see what do we have in the chat box. So can we take DIT trades at the equilibrium level, or should we take it at the low of the curve or very low of the curve? See, again, Aniket, this completely depends upon your personality style, right? If you are somebody who is very conservative, then you might say, I would like to trade the best locations, right? Irrespective whether it is a DIT trade or an HIT trade or an MIT trade or a WIT trade, right? So it all boils down to how aggressively or conservatively you want to trade. You understand the more better the location, the more conservative the trade is, the more aggressive the location, definitely the more aggressive the trade would be. So it will depend upon your personality style, your experience, right? All those factors will count in. Which tool do you use to identify whether a candle is a very bullish or a very bearish candle? Okay, so for that, what I do is I'm using the same tool which we use for the curve analysis. It's called as the fib retracement. And all I do is, I just draw it from the low to the high. And for this tool, I've done the settings, which is 0, zero point 0.2, zero point 0.4, zero point 0.6, 0.8, and 1. So now it divides this range into 5 equal parts. So I get to know in this case we are closing between 0 to 20%. Now what you can do is, if you want to understand how you can use these different tools and set it up for trading view, you can come to our website and go to the free tab. Here you have trading analysis, and then you have two videos here. One is in English, the other one is in Hindi. So just go through these videos. I think I've already covered this in these videos, and you can do this setup for yourself. All right. So while doing curve analysis for DIT trades, can we use tested zones, or should we only use fresh zones? See, when you're doing DIT trades, if I talk about myself personally, I would prefer to use fresh areas, and the reason for that is like I always say, the smaller the time frames, the lower the weightage. So that is where, as a DIT trader, I would definitely prefer to use fresh areas. But if you're using tested, there is nothing wrong with it. It's just that it's my personal preference. I would prefer to use fresh areas for DIT curve analysis. All right. So can we? Okay. Now let me also just quickly do this. Can you see if you want to use fresh areas for your curve analysis? Now, just as an example, if I'm on this time frame, I want to use fresh areas. So what I can do is I can say that show tested areas, I'll uncheck it, and now you will see it will do the curve analysis for me using fresh areas. So you can tweak the indicator based on that as well. So can you see when I say show tested, it will now do the curve analysis based on tested areas. If I say show fresh, it will do the curve analysis using fresh areas. So this can also be set up in your in the indicator as well. All right, so can we analyze as a DIT and take the entry on the 5 minutes chart? See, yes, but the only thing you should be doing now is, because your 5 minutes is the refining time frame. So if you have something on the 5 minutes, by that what I mean is whatever you have identified on 15, that is getting fine tuned on the 5 minutes, it is acceptable. But if you're doing your analysis and then just randomly going to a 5 minutes chart and picking any zone to plan a trade, that will not be very high probability. Okay, so thank you for answering my questions. I feel like no one has asked you as many questions I've asked. All right, perfect. So, see, again, these sessions are inclined, towards your questions, your queries. I mean, yes, we definitely do the analysis, but at the end of it, these sessions are for your questions, queries, right? So you don't have to thank me for it. That is what these sessions are all about. So wherever your questions, queries are, you can always put it in the chat box. I'll try my best to answer all the questions, queries that I get. Alright, so while using this methodology, I feel so overconfident might be bad for my journey, but I feel so because I was so blind, lost. Now I have a clear picture to what to do from A to Z. That is what these sessions are actually about, because I know a lot of people. They find it challenging to plan trades very mechanically and rule based. But yes, overconfidence is something which is not good, because what happens is with overconfidence at times we start getting into something which is called as over trading. So yes, any kind of emotion is not healthy for our trading. So what I'll say is, try to control that as well, because the more grounded we are, the better it is going to be for us. And at times what happens is, in fact, during the Hindi session, somebody told me the last session that he took 20 trades, out of which 15 trades were profitable trades, right? But today he gave me, again messaged me during the session that because my 15 trades were profitable, I got into overconfidence, and this week I had quite a few stopped out trades. And even the last session, I told him exactly the same thing, that yes, when we have a lot of winners, we do get into that overconfidence. We start increasing our risk. Start doing all those sort of things which we should be avoiding. And that is why I always keep emphasizing on that. The video that I have created for you, which is how to start trading, do ensure you follow that process. You might have to do it twice, you might have to do it thrice, and once you have gone through that process quite a few times, that helps you start controlling your emotions and be a more rule based trader versus emotion based trader. All right. So for a higher time frame zone, monthly time frame, all right, are you taking tested zones also? Is there a rule plan which you have for the times zone is tested? See, absolutely, for MIT trades, you will see I have been using monthly tested zones, and I'll give you the reason for that. See, the reason for using the higher time frame zones, especially for MIT trades, using tested zones is one. The bigger the time frame, the higher the weightage. The second problem is, if I'm only looking for fresh areas now, at times fresh areas might be really far away. Now, that is not the case with this example, but there might be examples where if I'm looking for something fresh, it might be really, really far away. So let me see if I can just randomly show you something where, we might have such a condition. Uh, let's see if we are able to find something. Now, let's take this example. Can you see something is trading somewhere around here? Now, if I want to use a fresh area, you can see my fresh area is pretty far away, even from the current market price. If you talk in terms of percentage, unless and until we go around 50% lower, will not be coming into a fresh area. So that is where, if I don't lean against tested areas, I might miss a lot of trades, right? So that is the challenge. But when we are talking about smaller time frames, let's say daily time frame, 60 minutes time frame, you don't need 50% corrections or 60% corrections or 70% corrections for fresh areas, which might be the case on these bigger time frames. So that is another reason why, for these bigger time frames, even if the zones are tested, I'm okay with it, because you at times might not get those deep corrections for fresh areas. All right, so can I request for the exact booster sheet you are using? I only take trades, okay, type 1 trades, but I feel bored filling the booster sheet. See, again, the reason I do not share this one is because here you can see I'm giving the scoring manually, but the other sheet which I've shared, there you can see the scoring is done automatically. So this one is not rocket science, right? All you need to do is just have a table, and here you're just doing the total of it. But I'm not sharing this purposely, because like already said, here you have to give the scoring, and you might make a mistake, but the sheet will not tell you you have made a mistake. So just as an example, if instead of 2 I give it 22, the sheet will still accept it. Similarly, can you see, if I give it as, let's say, 34, it will still accept it. So this sheet is not looking into whether the scoring is correct or not, and that is why I prefer not to share it. But otherwise, it's just one column doing the total, right? Similarly, just doing the total, that is all what this sheet is all about. So anyone can create this one. It's not very complex. The other one is still a little complex, so that's the reason I shared that one and not this one, right? So apologize for it. But it's very simple. It's just the sum of all these, and this is just the sum of all these, right? Nothing more. All right, so why is the probability of the strategy goes low for HIT? I have observed most of the HIT trades get violated when the first candle. See, it's not just about this methodology. Any methodology you're using, you will always see the smaller the time frame, the lesser will be the hit rate, right? And the reason for that is, on smaller time frames, if you think about it. Now, let's say I have a zone, right? Let's say I have a zone with 2 candles in the basing. Now, if this is a 5 minute chart, you can imagine how many orders can get executed in 10 minutes, versus if this was a monthly income trade. Now, this would have been the daily chart, and these would be 2 days. So the number of orders in 2 days versus number of orders in 5 minutes, in 10 minutes will be a huge difference. So that is the reason the smaller time frames, they have lesser weightage, because that quantity of orders can get filled really, really fast. And that is why you need to be extra conservative when you're planning trades on the smaller time frames. So if I give you my example, whenever, yes, I have done HIT trades as well. So whenever I used to plan HIT trades for myself, I will always plan HIT trades at the best location. I will only take HIT trades if they are also coinciding levels. So can you see, that is how you start adding that extra probability. If I'm planning HIT trades, I will still look at where my zones are located on the bigger time frames, like your dailies and the weeklies, to have that extra probability stacked in my favor. So yes, smaller time frames, lesser weightage; bigger time frames, higher weightage. And again, I'll say it's not just applicable to the demand and supply methodology. Any methodology you're applying, you will see the bigger the time frames you start using, the better the results it will start giving you. But on smaller time frames, you will definitely need to be more selective, right? So that's the only challenge. If I have 50,000 and with which I am starting trading, should I focus heavily on HIT and DITs, or also look at WITs and MIT? See, again, the first thing is that it has nothing to do with what capital you are starting. It has to first do with your experience, right? If you don't have a very good experience, if you've just started learning demand supply methodology, then I'll definitely say 100% avoid HIT trades. And the reason for that is, like I just said, the smaller the time frame, the lesser the weightage, the more selective you have to be. But how do I be more selective? You only get to learn that with experience. So irrespective of the capital you have, it is more based on the experience you have. So if you have lesser experience, yes, stick with WITs, MITs. If you have a moderate experience, then you can also start going into DITs. Now if you have very good experience, then start getting into HITs. That is how you should be looking at it, irrespective of what capital you have. Why does indicator not show levels on forex for HIT? See, the indicator will work on any symbol, whether it is forex, whether it is the Indian markets, whether it is cryptocurrencies. The only thing might happen is that at times the zones might not be very close by. They might be really far off, and you're too much zoomed in. So just as an example, let's say if I'm on a 5 minute chart on this one, so let's look at it as an example. So the indicator is still loading. Let's give it some time. In fact, let me also do this. I'll say explosive. So now this one is not a very good example, but if I go through few symbols, I might get a good example to look into. So let's see if I'm on this one. Do we have something? Or maybe I'll just change the time frame for the indicator to load faster. So I'll still have something here. So this might not be a good example again. So just give me a few seconds. Okay, now the problem is I have also selected this. Let's disable it. Now the indicator should only throw quality areas for me. Okay, so we have something on this. Let's see, do we have something on this? I think we'll be having some demand areas right here. Perfect. So again, we'll have some supplies. So I'm not able to find and I'm not able to find an example which I can show you immediately. So yes, what I was talking about is, see, at times what might happen is, whatever, like you can see now this example, can you see I have a lot of candles on the chart, but the indicator is not marking anything for me. Why? Because by default it is supposed to identify quality areas, and within these number of candles I don't have any quality areas. But if I zoom out, now you can see the indicator is showing me quite a few supply areas, but still no demand because I don't have much data. If I bring in more data, now you can see I can even see some demand areas which are coming from the past. So you can see all this area, we don't have any demands as well. So that could be the reason. Maybe you're too much zoomed in, and since you're too much zoomed in, there is nothing quality available on that particular data. It is not showing you, but otherwise it has no limitation. Whatever symbol you will be applying to, if there are quality areas, it will identify for you, right? But again, if you feel there are some areas and it is not identifying, you can always share a screenshot to info@Surjit We'll look into it and we'll get back to you. Otherwise, if there are quality areas, it will definitely identify. I understand the logic of using the tested zones, but is there a rule for the number of times the price has come back to the zone? See, I personally don't follow any such rule number of times, but yes, if you want to follow it, maybe you can say up to 2 tests I'm okay with it, but then again at times you will see for 3, 4, 5, 6 tests the zone might still hold. So I personally don't follow any such rule for the number of tests. But yes, if you want to do it, maybe based on your experience, you can look into it, or maybe you can do it based on how deeply the prices are going into the zone. So you can see unless and until prices are going less than 50% deep into the zone, I'm still okay with it. But once it starts going deeper than 50%, or let's say deeper than 75%, that is the time I would like to avoid it. So yes, you can make your own rules based on that. So it can be based on number of tests. It can also be how deep the prices are going into the zone. So that can help you make your decision if you wish to. All right. Uh, Thanks. Take frame or take data in this price based, which is far better the time frame demand than time frame. See, now the problem is with tick based, at times in a minute, very few transactions might happen. At times in a minute, a lot of transactions might happen. So, what this can do is your first candle might be, let's say, if you say, I want to have candles based on 100 ticks. So, at times, 100 ticks might happen in just 1 minute. At times, 100 ticks might happen in 5 minutes, which might not be very consistent when we are trying to see the charts. So I have never tried it based on the ticks because um, I don't know because from the very beginning it has been based on the time frames, but somehow I feel time based would be much better versus tick based because again different symbols will also be having different liquidity where the same number of transactions might take a very short time to a very long time period. So I think time based will make it more consistent. I guess that would be a better way to go about. All right. Are there any some additional rules I can add to HIT trades other than the PDF? So, like I already told you, the rules which I follow: one, I only trade the best locations. Two, it always has to be a coinciding level. Three, for even for the curve analysis, I only use fresh areas on the higher time frame. So these are the three which I was following. And like I already said, other than this, I would also check whether on the daily and the weekly how I'm located when I'm planning those HID trades. So if you're looking into these 4 5 factors, definitely it will improve your hit rate quite a bit versus what you were having before if you just take care of these 5 different considerations, right? So I think that should be more than sufficient. All right, perfect. So that brings us to the end of today's session. Thank you everyone for joining in. I will be seeing you now next weekend, which is going to be probably the next Sunday. Till then, stay safe. Enjoy your evening. Take care. Bye bye.